What's going on, guys? Welcome back to another inter-equity trading video. Today's a really good one. I've been looking forward to recording this for you guys. I've seen a lot of questions and comments asking me about liquidity from the left. How far should we look? What price action's relevant? All these different things. Good questions. This video is going to answer all of them. I go into depth about how important it is to look to the left-hand side. Yes, the current price action is important and you want to understand where liquidity is. However, the missing component to a lot of your trading is understanding where the liquidity is to the left-hand side. Let's hop right into the charts. Okay guys, so here we have a specific diagram drawn in front of us. First, I want to go through this concept of liquidity from the left. What does it mean? Why is it relevant? Why is it so important? And then after you guys have the understanding down, we'll head over into chart examples and show you guys direct examples. So without further ado, let's hop right into this diagram. So let's break this down step by step. Okay, so we have a big sell-off to the downside here, okay? Printing a low in the market, going bullish, printing a high, another low, and then we end up springing to the upside, taking out previous high. A lot of people in the industry will look at this as maybe a BOS in the market, okay? Maybe other people are gonna look at this as a sweep of liquidity. Why a sweep? Well, because this high respected this high and it built liquidity, right? So people can view this as a liquidity buildup. So either way, there's a BOS or a run on liquidity. We're just gonna leave it blank, okay? I just wanna make sure you guys understand where I'm going with this. So again, we print a new high. From there, we sell off to the downside, we respect the lows, building liquidity, and then we run that liquidity to the downside. From there, again, look what happens. We go bullish again, and then we approach the high, we temporarily respect it, building liquidity above that high, and then same thing happens. We take out this high and this high, and then we start showing bearishness. Now, this is where a lot of people make that mistake. So let's just say, even for example sakes, there's an imbalance over here to the left-hand side. And now you have people looking for sells in here. Not wrong. However, you need to understand that this sell-off to the downside into this low, it's gonna be short-lived. Okay, it's gonna be temporary, you could say. It's not going to be that actual reversal to the downside, and there's a reason for that. So yes, this is a run on liquidity. However, it's not enough for the market to just get sold off all the way back to the downside. It won't work like that. So what happens is, again, we have this reaction to whatever this is to the left-hand side. This could be a POI for retail. Again, this could be some sort of imbalance, an order block, whatever it is. We run these highs, we tap into the left-hand side over here, okay, and it shows bearishness to the downside. Again, respecting this internal liquidity point once, twice, and then we get that move up, and then we get that sell-off to the downside, clearing that liquidity. Again, when this happens, you need to be looking for buys down here. Why? Because this reaction from the left here, all this is doing is building liquidity. You have to ask yourself, where is the liquidity? And that's gonna be right here. Okay, now this brings me to my whole point on this whole video, is the liquidity from the left, and that is right here. The reversal won't occur until this high is taken out. And if there is some sort of bearish moves, expect it to be pullbacks, and then eventually just a continuation up. Every single time we get this reaction here from this high, from this high, from this high, all that's doing is it's building liquidity above this high. That's it. So again, every single bearish move, and what we can do here is mark this out. So we have a bearish move here. We have a bearish move here as well. So we'll copy another one from high to low. The next one will be here from high to low. Every single time we get these moves, again, from high to low, high to low, high to low, you have to view them as pullbacks in the market. Why? Because we have not taken the liquidity from the left yet. And that's the most important part. Yes, we have taken liquidity from this high. We have taken liquidity from this high, and then this high, but the most important part here and the most important component is this high over here. Once we take this high from the left-hand side, what you can anticipate and what you can expect is the market will now reverse, okay? It doesn't have to be a very aggressive move. Sometimes what will happen is we'll induce buyers here, get a sell-off. And then again, sometimes we can struggle here for a bit. Why? Because we're inducing buyers from the left, and then eventually we get that sell-off to the downside, okay? But the most important part to this whole scenario here, this situation, is understanding we won't see that reversal until that high is taken out from the left-hand side, okay? And I'm gonna do something quickly for you guys and invert this so you can see this on the buy side, okay? So look how the buy doesn't occur until that liquidity from the left is taken. We're not buying from here. We're not buying from here. I'm also not gonna say you don't want to, it's wrong, because no, it's not. You can catch short moves, you can catch pullbacks, yes. But if you want the big move to occur, this one down here, you don't want to involve yourself in buys at these lows. You want to see the reactions, okay? Because what that's doing is building liquidity at this low, and you want to see that. However, if you want to catch the reversal, you wait for this low, and then you catch that move to the upside. Okay, cool. So now what we're gonna do is hop into the charts, all right? And I'm gonna show you guys some direct examples of what I'm talking about here. So the first one I'm gonna show you guys is right in front of our eyes here. On the 15-minute chart, we have gold taking out this high from the left-hand side. That is important for me because now we have built liquidity at this low. Okay, and look what happens after we take that low out. We start seeing that bullishness, right? But the missing key here, a lot of people fail to realize, is this low was not the important one. You have to look to the left. This low here was the important low. So this is your liquidity from the left-hand side. You mark it out, you drag it over. Cool. That was the low that needed to get taken out. Of course, this one, but the important one is here. That's the low you need to see get taken out in order for that reversal to occur. And look at this. If we can just follow along with price action, we'll go into the 5-minute chart here and look, same thing occurs here. We get this big bullish move to the upside here, okay? Taking out these highs. Why is that important? It builds liquidity at this low. Right, so look, we take that low and we go bullish. But again, what a lot of you guys are failing to realize is it's not this low that needed to go. Look to the left. Same thing. These lows needed to go in order for price to run bullish. So that's how you're able to catch the bottoms sometimes or the tops. Okay, understanding where the liquidity is to the left-hand side. Now, the same thing occurs over and over and over. Look at this now, and we'll go into the 1 minute just so we can identify it. Now I have another example for you guys now on the sell side. And this is actually almost a picture perfect example from what we were talking about on the diagrams, on the buy side of things. Look how the market takes out this high and we get that sell off to the downside, right? Here's that one buy opportunity. Now the market goes bullish, takes out this high. A lot of people would start looking for sells once we take out this high over here. And you'll be looking for sells in here, and look what happens. It goes bullish more. Now, why does it go bullish more? Look at this. I'll grab this high, drag it over. Now the sell is valid because that liquidity from the left-hand side is now taken out. Yes, this high, because that's important for sure. That induces buyers, but you need that liquidity taken from the left. So look, we grab that liquidity, then the sell occurs. And look, short-lived. All it does is grab some liquidity from the left. We have a reaction up, a reaction down, back down to the extreme, and we continue bullish. Why? If we want to see a big bearish move occur, it will not happen until that liquidity from the left is taken, and that's going to be up here at this high. Now, this is a gold chart at live time, so we have not seen that bearish move back down yet. However, if people they want to look for sells, the sells cannot occur until this high is now taken. All right, guys, I hope you enjoyed today's video. I know. Maybe a lot of light bulbs are going off in the head now and the eyes are being opened up to these liquidity concepts. If you guys have enjoyed, please leave a like, please leave a comment, turn those notifications on. We have a lot more videos coming for you guys. So keep an eye out and we'll talk soon, guys. Take care.